Howdy. It's Friday, the Friday lunch hour. Welcome here at Finance Friday, coming at you live at Inside Production Studios in Phoenix, Arizona. And for the next 30 minutes, we'll be talking to you about money, building your wealth, and quite possibly those hot stock tips that we keep waiting for every week. My name is Robert Morales from RCO Network. Good people, better business, discovering the best of you. And again, my esteemed co-host today from the College Group, Mr. Francisco Ayala.
Hello. Coming today from the finance capital of the world, my bedroom.
That could work, sir.
Yeah.
So I'll be taking questions live. If you type in those questions and comments in the section during the broadcast, we will answer them as we go along. Please give us those heart emojis because we love the loves. If you're watching us on YouTube, smash that subscribe button and you'll be notified of a future post as we post them. Mr. Ayala, how are you?
I'm doing well. Can't complain. Nice day outside. And how about yourself?
Pretty good. Quite the interesting start today. A little off.
We didn't get that big stock news this week. Did you notice? A couple of weeks ago it was the GameStops and stuff. Last week it was Bitcoin. This week nothing too exciting. Just a continuation of the same old thing. So.
We did get some interesting news regarding unemployment, though.
Yeah, right.
So, did you hear? Can I post that? Can I put that?
Oh, go ahead. What do you want? Yeah, share it.
Look at that. Another 861 workers filed for unemployment benefits for the first time last week, according to seasonal adjusted data released Thursday from the Labor Department. So that was just yesterday. So 861,000. I think the expected was roughly about 740. So it's definitely an increase. And when you see stuff like that, as somebody in wealth management, when you see stuff unemployment wise creep up in a number like that, that's unanticipated, what does that signal to you? Or I guess, what does that kind of?
Well, so that number has really stayed the same, fluctuating up and down a bit, but that number has stayed the same, which is elevated for quite a bit of time. Okay. And so what that signals to me is that, again, we are still in an economy that is still trying to get its footing, right? A lot of people are still being laid off, businesses shutting down. And so we are not at that point where we're hiring those. We are definitely gaining some of the jobs that we lost during the big dip in about a year ago, last March and April and May. But there's still a lot of people that are being laid off. And so it just means that there's quite a bit of instability in the economy. And those numbers are not turning around to the point where we can say, this stuff is really turning around and we're on a rebound now. So
yeah, because employment really signals growth, right? I mean, if people are hiring, it's because they need more workers to build or service whatever they're trying to do. So that, to me, employment just signals that we're heading in a positive direction, at least as far as growth goes.
Yes, exactly. And the fact that companies are not hiring right now, and to the contrary, some of them are still laying people off, means that these companies are unsure, right? If they knew that we're turning the corner and things are going in the right way and getting momentum, then they'll probably be anticipating that and trying to get ready for that. But they're still not doing that, right? And so that it's kind of a signal from them saying they're not optimistic yet. I mean, they're still hesitant. They still don't want to spend the money because they don't know when they're going to recover that expense. And so, yeah, it's still it's just uncertainty is really what it is,
Yeah. And the more growth we get, the more we're able to buy down all that debt. The stuff we talked about last week, I mean, our production really just, again, is a signal of the future that we can pay down all the debt that we've been accumulating these past few years.
Yeah, right. It's like we mentioned last week, is like debt in itself is not really an issue if you have an economy that's really growing, right? Because you'll be able to pay that off, and with your payments stay the same, the economy keeps growing, so the debt becomes less and less of a burden for you. But if the economy doesn't grow, then you're stuck with a big old bill, and so there you go.
So it sucks. So, yeah, I mean, again, looking at our economy as our own purse book, sometimes we take advantage or at least want to look for that quick way out. And I think that's where our markets are at right now. I'll give you an example. So a news article from JP Morgan was released. I think I sent that to you earlier, sir. People are looking for easy ways out. They keep hearing about all these stocks and stuff emerging. Like I think GameStop was that first stock of the signal this year. Like, hey, I can make billions of dollars off this one stock. And so the chief investment officer at JP Morgan Assessment Management with 2.3 trillion overall is betting an ever more intensifying rally to junk bonds, emerging market debt, and risky bank securities. So you see that, I think more frequent. I think so many people, at least this is from my perspective, you can kind of chime in too. So many people are looking for those easy way out, and they're investing in these companies. I wouldn't even say investing. They're just buying whatever they can, a FOMO moment. We've talked about behaviors too. And again, you can kind of go over that, but they're having those FOMO moments where they're like, holy shit, I just heard my friend down the street or my neighbor next door, they just made 10,000 buying what? Bitcoin? Oh, maybe I should go buy it now. and I mean, I guess you can have your opinion about Bitcoin, but there's just so many weird junk stocks like GameStop that came up, and people are just rushing to buy it. And then all of a sudden you just got to rush out the door. And I'm starting to see that more and more.
Yeah. So, I mean, what the JP Morgan investment officer there is buying is what he's buying is debt, really, whether it's junk bonds or for emerging market debt or stuff like that, which those have very different characteristics than stocks. Yep. I mean, what he's buying though is the junk bonds. So meaning he intends that the loose monetary policy and the loose fiscal policy of the government coming in, creating some stimulus, and stuff like that, that there's not going to be other way. There's not going to be another alternative. They call this the Tina effect. There is no alternative, meaning that interest rates are going to be low for a while. And so you're not going to get, a safe yield from, what you usually would get it from treasuries and good, corporate bonds. You're going to have to go somewhere else. And so he's going into junk bonds, right? Because they do pay a higher yield. He's going into emerging market debt. And from that same effect, though, you get the run up in stock prices too, because if you can't be investing in a safer asset like treasuries or stuff like that, you're going to have to go to stocks. And a lot of people get that same mentality. And yes, you're right, that herd mentality of fear of missing out is kind of when you get those real big spikes in stock prices.
Yeah, and we're here at the lunch hour, so we're going to be on for the next 20 minutes. If you have any comments or questions, go ahead and type those in. If you like what you're seeing, hit those heart buttons because, we love those loves all the time.
We sure do.
But we're talking about just this market right now. I don't even know if the term investing is really the thing. I mean, I think it's gambling right now. It's, from my perspective, my opinion, people just going in, and this is a good example of this. So I'm gonna put this up to you.
Sure.
I have examples. I'm not just talking out of my, what. So this week, because of all this FOMO activity, because people are just going crazy and buying whatever. So I downloaded this from Krista Galindo herself. She might be out there watching. She said, hey, sign up for this new app called Clubhouse. Clubhouse, from my understanding and from my limited knowledge, is an app that allows for like these podcasts and for people to connect. Another social media platform, very little unknown about it. But because of all the FOMO activity, people just rushed and bought Clubhouse Media Group stock prices, and it surged over 1,000% this week, which is nuts because the app
it's the wrong stock, right? Yeah.
Yeah, the app had nothing to do with Clubhouse Media Group, and and you can chime in a second.
Yeah, I mean, you'll see that quite a bit where you get companies that kind of sound similar, and people buy the wrong stock. So this leads to a very interesting point about whether you believe that markets are efficient or not efficient, right? If you believe that markets are totally efficient, then that means that there's really no way to make money off of kind of these speculative things, right? The market incorporates all the prices, and that's what the market, that's what the price is, and there's no way that you can really get an advantage versus anybody else. This goes to show you that the markets are not truly efficient. Now, personally, I believe that the markets are very efficient, and that not totally, but very efficient. And that being able to consistently outperform the market or outguess it is very, very difficult. But this shows you that it is possible, right? Because not a lot of people are understanding what's going on. And you see this activity, people that can anticipate, and people are out there that can anticipate this. And, a lot of these arbitrage and hedge funds and stuff like that, they'll anticipate this and they'll be able to make money off of it. So there's quite a few people that can, but it's just hard to do. But it's just a very, very good example of how people, they just don't know what they're doing out there. A lot of people, they think they're, again, talking about investing versus speculating, they think we're investing. Well, they're really just speculating, right? Because you just see this flow of money coming in and out of these securities.
Yeah. And so I guess the one takeaway that, and you can give your own takeaway too, the one takeaway regarding all this FOMO activity, because I get caught up in it too, man. I mean,
yeah. Oh, yeah.
I was looking at GameStop and I was like, maybe if I just, throw in a little bit, it's only at $100 and something right now. If I just throw in a little bit, I mean, it rocketed up to, I think GameStop rocketed up to like almost $500 a share,
right?
Like $490. Right. And it's like, man, I could have been on that wave, but people get caught up in that. That's the whole appeal of Las Vegas. It's just a big, you see all the lights, you see all the things flickering, you see people cheering on, and you're like, holy shit, if I can put my $100 that I have in my savings, because a lot of people don't even have an emergency fund, by the way. And,
right.
And I think for you out there that do that,
vast majority of Americans.
I mean, if you're like my brother and end up buying a Bitcoin at $8,000, he bought one share. He told me like a couple of years ago, hey, you should buy Bitcoin. And then he ended up buying a share at 8,000. Now shares are just well over 50,000 a share at Bitcoin. And that that irks me, and that gets me wanting to go and look for that next thing. And you get that enough and you start gambling away. But going back to behavior is the thing we've talked about before, is you got to mind yourself. You got to watch yourself with some of that stuff and don't get caught up in the hype. Don't get too crazy about it.
Yeah, right. I mean, we talked last week, and probably something, that document that I shared with you. I'm not sure if you want to bring it up, but we talk about really what is investing and what is speculation, and all that I can suggest out there to the viewers is know what you're doing, right? Know which side of the argument you're on, whether you're on the investing side or whether you're on the speculating side. But know that if you are speculating, know that it is speculation. And again, you can make money off of speculation, but it's hard to do consistently, but just know that you are speculating and it's not really, investing because there is no really clear-cut definition of what is investing and what is speculating, right? There's not going to say, oh, this is it. It's just basically up to you to decide. But for my personal take, is investing is that you're going into somebody because you believe in the product, in the company, in the earnings, in the growth and stuff like that. Whereas speculation is you're going in, we talked about the greater fool theory last week, right? Whether you're going in hoping to sell it to the bigger fool that's going to buy it from you higher, and so that's kind of the difference between those.
Yeah. And if you're basically watching it on the news right now, if you're barely hearing about it, you've already missed the boat, quite honestly. And so I'm Robert Morales, RCO Network, here with Francisco Ayala from Collards Group. I'm not going to screw that up this week. Talking about finances, how to grow your money, and all the things about this market that people don't know. I think when we started this whole adventure together, it was coming from a sense of really genuinely trying to help people out there. So as you're watching and as you're engaging, please leave those comments. We're going to get to those. We can answer any questions, even offline there too. Hit those heart emojis because we love those loves. But the last part of our show today, I wanted to focus in on a few stocks, and I did want to provide my own stock tips, even though Frank refuses to reveal his portfolio. So I wanted to talk about kind of the terms and things I look at regarding stocks, and I wanted Frank to fill in too.
Sure.
And I'm more of like, I want to get up in the FOMO kind of area. I mean, the guys around here all talk about stocks all day. And so I'm hearing about like, I made 10,000 a day. I made 50,000 when I woke up today. I'm like, what did you buy? When did you buy? Hey man, anybody who talks about stocks, I'm kind of keeping my head open.
Yeah.
As far as investing goes, because at the heart of hearts, I still want to invest. I still want to grow my money. And in, quite literally 25 years from now, which, we'll be 65 and old, we'll be gray hairs and everything, Frank.
If we're running out of hair, so there's going to be much gray there.
That's the thing we have in common. Yes. So I do want to have a nest egg to where I can just, live off a beach somewhere, or at least have the option to live off a beach. I know myself, I wouldn't necessarily do that because I think it's a waste of time, but I want to have the option to do that. So is there anything that you would want to provide or suggestions? You did send me some PE ratios on some companies.
Well, look, I'll say this, first of all. In the last couple of weeks and now we go in our next, what we're going to transition to, we're going to talk about investing. And that's all we've been talking about is investing. But a successful financial plan is a lot more than investing. Okay. Investing is a big component. Yes, you want that compound growth. You want money to work for you without you having to do much. Compound growth is one of the best things out there, right? And there's no kidding about that. But a successful financial plan, for you to have financial peace, you need both offense, which is the investing, but it also includes the savings. How much are you saving? How much are you, doing other kinds of stuff? And you also need defense, making sure you have the right protection on certain things. I mean, I'm going into here the kind of a broader perspective of what is successful financial planning. But yeah, financial planning incorporates having the right insurance and the right estate plan and making sure you have the right products and stuff like that. And so investing is just a component of it. So it's an important component, but it's just one component.
And you can help navigate people through there. I mean, they would essentially hire you for your services, and you can talk to people offline regarding that, but you can help navigate through them.
Yeah, I mean, I think whether it's with me or with somebody else, I would like the viewers to understand that it takes a lot more than just investing. I mean, if you're going to invest $100 or $1,000 or whatever it is, and you think that with that investment, that's gonna fund your retirement, I mean, you're kidding yourself, right? It's about having a plan. It's about being intentional with what you do with your finances, right? How much are you saving? Are you saving enough, depending on what your goals are, right? And are you investing the right way? Yes, but do you also have buffers, right? The safety nets about if something happens where you become disabled or things like that. So a good financial advisor is going to cover all of those things and not just the investing.
Yeah, because I was watching Chipotle stock from last week, and it dipped. I'm glad I didn't take your tip.
Hey, I said I was going to go have lunch at Chipotle. I never said I was going to go buy the stock.
I was just joking about that. It's currently at $14.74 a share. But I did want to, because again, I think the overall resounding thing that people want to know is that quick hot stock tip. So I did pull some stocks, but I pulled some stocks and again, I'll get your feedback regarding that. Am I looking at the right thing? Am I wanting to invest, long-term? Because again, people are looking at stocks and wanting to invest, and you might as well talk about it now because, it's just what people want. Right. Sure. So I have my top 5 stocks for long-term investment. Right? Mm-hmm. Long-term meaning buy and hold. Mm-hmm. I'm going long. And I haven't bought these yet, but I'm actually thinking. So my first stock tip of the day in this last 5-10 minutes that we have is going to be with Medtronics. Have you heard of Medtronic, sir?
Familiar with the company. Haven't personally invested in it, but I am familiar with the company.
Medtronic. I'm going to pull it up now. Boom, right there. Medtronic. Currently on, it looks like a bear market. 113 a share. So what I wanted to look at and what I typically kind of take a glance at is the dividend yield. On here, the dividend yield is about 2%. PE ratio is really actually really good, 41.54. So PE ratio is what, Frank? Do you want to explain that?
It's just a ratio of the price to earnings. And so basically it tells you how much you're paying for every dollar of earnings. You are paying $41 for every dollar of earnings that this company generates. And you say that's good, okay? And so I want to question you on that. Why do you think it's good?
Because I believe after this pandemic, I mean, we will go back to regular medical care. Medtronic tends to focus in on cardiovascular. They do like the fake limb stuff. I mean, going back to regular medical care, because at some point we're going to get off the COVID thing. It's not going to be an emerging issue. It's going to kind of go into the realm of the flu season kind of thing at some point. It's not right now. So we're going to get back to our basic healthcare, and some of that is, just general care. A lot of what they focus in on is implants and replacement parts. And they've been around for a long time. Looking at their good market value, I estimated they were earning between about 118, adjust for debt. The good market value would be 106. So I'm watching that, see if it dips to about 106, and I think that would be a good buy. Right now it's at 112.
Well, okay, so we at least we have an analysis here, right? We're doing some sort of analysis about your assumptions and your predictions and stuff like that, which is good. Which is a lot better than the speculation of I'm going to buy it here so that I can sell it higher because right? Because stocks always go up, and so I can't lose money. So if you want to bring up real quick that sheet maybe that I sent you, I want to talk a little bit about at least one form. This is going to be very basic. It's going to be a very basic form of analysis that our viewers can use, right? I have a couple of stocks here, right? We have Kimberly-Clark.
That was mine. I like that.
You mentioned, I put that in because you mentioned it a couple of weeks ago. You have Kimberly-Clark, you have Apple, you have Zoom, and you have GameStop. Okay, you have on the first row, you have the price of each. On the second row, you have its earnings per share. And so you divide those two and you get the price to earnings, right? So what this is saying is that for every dollar of Kimberly-Clark earnings, you're going to pay $19. For every dollar of Apple earnings, you're going to pay $34. And then Zoom's $290. And then GameStop, as you know from your elementary math, once you divide by a negative number, then you get
nothing. Negative returns.
Exactly. So let me ask you this.
Oh boy.
Why would you pay $35 for a dollar of earnings for Apple when you can pay only 19, almost half of that for Kimberly-Clark? Why would you pay almost double for Apple?
Because you believe in the product and you believe in the long-term longevity of the company, and that their earnings are going to be over time better than they are now. You would hope.
But wouldn't that also be the case for Kimberly-Clark? Don't you believe in the company? It's a big company, and it's going to be around for a while, and you expect earnings to grow. So why would you pay double the price?
I don't know. Because I'm crazy like that. Apple seems sexy to me.
Right. So one takeaway there is that the reason that you're willing to pay more, because all these prices, what these prices reflect is millions of people buying and selling, right? Millions of people are buying Kimberly-Clark and Apple and all these things, and you're getting it to a market price. Why would people pay such a higher price for one over the other? Why would people pay $400 times earnings for Zoom than you can pay for Apple? The reason for that is because you believe in the growth of the company. You believe that Apple earnings are going to grow more than Kimberly-Clark earnings. And so because eventually those earnings are going to come back to you in the form of either stock price appreciation or dividends or something, you're willing to pay more for that right now than you would Kimberly-Clark. Now, Kimberly-Clark, yes, it's a well-known name and established company, but their earnings don't grow as much anymore because they don't have the sexy products, right? The only
toilet
thing
paper.
Kimberly-Clark is like a new scent of toilet paper or something like that. I mean, that's as technologically advanced as you get with Kimberly-Clark, right?
Yeah, you can't get softer than Cottonelle, I tell you.
Exactly. Or maybe they get an extra soft, but that's really the innovation coming out of Kimberly-Clark. Whereas as Apple, you might get an Apple car in the future, right? And so you anticipate that the earnings for Apple are going to be a lot higher than Kimberly-Clark. That's why you're willing to pay double the price, right?
Yeah.
So now going to Zoom. Zoom, we saw was
go back there
then. It was $290. Okay, why would you pay $290 for earnings of Zoom? Here is when you kind of start losing the fundamentals and start going more into speculation, in my opinion. Okay, do you really think now that Zoom earnings, given where we're at in the pandemic and that everybody's doing Zoom, we are doing Zoom and stuff like that, do you really think now that the earnings of Zoom are going to grow that fast that you can justify paying $290 for every $1 of earning? Then you see, so these high PEs, now they start getting more speculative, right? And then finally, GameStop, you have negative earnings. They're not even earning money. They're losing money right now. Yep. Yet people are buying it. They were buying it like crazy. And so again, another that kind of is more towards a speculative end. That doesn't mean that companies that don't have positive earnings are not good investments. For example, Amazon was losing money for a long time, but you knew what they were doing, right? You knew that they were investing in the company. That's why they were losing money, because all of the earnings was getting put back into the company. And look at it now, right? But what about GameStop? I mean, do you really think, is it growing? I mean, do you see GameStop's stores opening left and right and people are dying to buy the games and stuff like that? Not really, it's like, I don't see that. And so to me, that's just unjustified.
Well, maybe because I have 4 more. I have 1 left. The last one I saved, and I want to get your opinion on there, sir.
Okay. All right.
So my number 2 stock right now. This is for long-term investors. It's a little bit pricier than some of them, but I did want to share it. It is this one, Home Depot. So Home Depot is currently sharing. It went down from this morning. I had 283 this morning. It's down to 279 a share roughly. Dividend yield on here is going to be 2.14 and a PE ratio of 24.21.
Okay. So we have a PE ratio of 24. Again, you're just all it's saying is that you're paying $24 for every dollar of earnings. There's a couple of things that you can do with that PE ratio exclusively for Home Depot. One is you can see historically what its PE ratio has been. Has it always been around $24, or was it $15 before, and now the price has gotten so much higher that now you're paying $24 24 times earnings, right? So that's one way to compare it, is historically what has Home Depot's PE ratio been versus itself. The other one is compare it to its competitors, right? So you can compare it to Lowe's and Walmart and other,
Hardware, I think
but really Lowe's would be probably the best comparison. What is Lowe's PE ratio, right? And because that might mean that gives you at least a comparison. If Lowe's is trading at a PE ratio of X, why is Home Depot trading at that? Right? Is it more expensive, less expensive? And why would that be? So that's another way that you can kind of factor in your analysis, right? Is compare PE ratios across time and compare them across competitors. So you can kind of get an idea of the value of what you're getting for every dollar of,
Oh, and so like the reason I picked Home Depot as a possible long-term solution, it was one of those companies that, had high earnings during the course of the early onset of the pandemic. And I believe, in the future, because I do the real estate part too, I believe in the future, we may have some fluctuations in the housing market, which will drive people. I think people are way overpaying for housing right now.
Mhm.
Uh, locking in those low term refinance rates and not moving, not selling, but they will be building up what they purchased. I mean, if you there's houses right now going 100, 200, maybe not 200, but definitely 100,000 over list price or over appraised price. Those people aren't moving. They're building up their houses and going to Home Depot and Lowe's and stuff on there. So that was kind of got my attention. I figured I would most likely purchase that stock when it hit about 241, 240 after I did some analysis regarding adjustment after debt. 241 was my target group, and I'm glad to see it dropping a little bit, because if it drops 40 more bucks, I'm in it to win it. Okay, so the next company I had on my list, number 3, we're coming closer to the end of our half hour today. Look at that.
Time's flying.
We got to step it up.
Huh.
This one is
What do you got here?
Pepsi.
PEP.
Yes, sir. PEP. So the reason, again, I have Coca-Cola stock personally, but I was looking at Pepsi. They tend to be more creative. I think Coca-Cola in itself, like I said, I do have stock in there. They tend to be, the Titanic. I don't think anything's going to sink Coke necessarily, and people are always going to buy soda for whatever known reason.
Mhm.
I don't necessarily believe in the product, but I believe in the company. And so looking at Pepsi, if you ever worked with Pepsi, ever worked in a restaurant, they tend to be very aggressive with their sales tactics, like bringing in Pepsi machines, and they give you a discount if you're only Pepsi exclusive. So if you notice, if you go to restaurants and they only serve Pepsi, it's because they get an incentive to only sell Pepsi. And if you sell Coke products, they don't give you that incentive, which is kind of crazy. So they do have, a significant market share too. But again, their current stock price is 132. I figured they'd be a good buy if they continue to decline because of their, the dividend yield on here is 3.02, as well as a PE ratio of a 25.89. And again, they've been pretty stable for a number of years. People, I don't think, are stop drinking soft drinks. They also branch out into the personal consumption, stuff like the little Ritz crackers and whatever else products they have.
Right.
I don't know if Ritz is one of theirs, but they branch out way more than Coke does. Like I said, Coke is the Titanic. There's really no innovation, really no kind of broadening. I mean, if anything, I think they got rid of Tab, which was, I don't know if any Tab drinkers out there. That was disappointing. That probably lost them some market share, but Pepsi tends to be a little bit more into it. So I think they're a good buy at around 106. Again, long-term company. You don't necessarily buy this and sell it. It's not sexy, but it is its own tugboat. It's not a Titanic, but it is a tugboat, and it does carry its weight.
Yeah. So I see where you're coming from. Where if we get a big enough price decline, then that would make it a good buy. And basically, again, going back to the PE ratio, what that would do is if the price declines, your PE ratio goes down. And yeah, who doesn't want to buy things cheaper, right? That's the whole point of buying low, right? Is buying them as cheap as you can, so you can participate in the price appreciation. So the thing with Pepsi, it is a consumer staple. I mean, whether yes, they're perhaps more innovative than Coca-Cola, it's still a consumer staple. It's not like if it's a technology that's really disrupting the economy, and that you've seen for those very high growth stocks, right? This is kind of more of a value stock where you're buying for stability. You're buying it for stability and not so much for growth.
Perfect. And then we had 2 more. Next one is, drum roll, please.
Run.
Waste management. So right now, currently trading at 111.
A bunch of crap. That's what you.
They get rid of your crap. Absolutely. Trash. I mean, that's not going away ever. As we live as humans and as we go to the bathroom, there's not going to be a day or time where waste management is not needed. I don't know if they have really big competitors other than local municipalities possibly taking on their own trash. But they pay for golf, every year at Scottsdale.
They sure do. That's a big old party.
But again, a dividend yield of 2.03, a PE ratio of 31.53. I do like them because they're not going around. I think I'm a buy when they drop down to 94, but $94 a share. And that's based off a little bit of analysis regarding after you remove their debt. I think they're a good company and they're a good buy around $94 a share. And I don't think they're going anywhere.
Again, another consumer staple company. Yeah, I mean, what you're doing is you're buying stability, right? And that's good to have stocks that offer you that stability when the economy tanks and everybody's, you expect these companies to have the cash flow to pull through, right? Which is what happened at the beginning of the pandemic. You saw the Kimberly-Clarks and the Pepsis, like all these companies are the ones that performed better, where all the growth companies, all the technology companies and all that were the ones that were kind of lagging, But so you definitely want to have some of that, but why do that at the expense of something else, right?
Yeah, so I'm hoping it drops down a little bit, and again, more of a long-term kind of gain there.
Right.
Last one of the day. This is the tricky one. This is going to get some hopefully feedback from you and maybe somebody from the audience.
All right.
Let me go back. Where am I at? IBM.
IBM. Wow. Okay.
International Business Machine. So this one's trading currently at 118. It keeps dropping. I like that. Dividend yield of about 5.4%, right there at the bottom, as well as a PE ratio of 5.43. So this company, well-founded, is one of the first computer technology companies really out there ever.
It's a dinosaur.
It is a dinosaur, but Mr. Yell, they are making renovations. They just hired a new CEO in 2021. And they're trying to branch into the cloud services industry. They're trying to do some new innovative things. I have no idea. I got kind of information from one of the guys that does websites here. He's like, there's a lot of innovation regarding iCloud technology that they're kind of forefronting, as well as their AI. So they have heavy investments. Right now, their debt is really high. But just like how we're talking about Amazon, they were high in debt. I believe that they're investing in their company to get ahead. I mean, like I said, they're a dinosaur, but they're a big dinosaur and I believe with some of their innovation and kind of the things that I'm hinting around. If you go actually to the website, the IBM website, you can read a little bit more about their AI products and kind of the future of where they're going. I mean, they're not necessarily in a competitive space, but I do think it's an opportunity to get in early, and then over the course of the next, maybe 5 years, as AI, artificial intelligence does increase and becomes more and more part of our lives, that's going to be a stock that's going to bring some yield. So I'm waiting for that. After you remove all their debt, I'm considering buying right now, because after you remove their debt, they're a good fair market value is about 192 a share, and right now they're about 118. So
okay,
I'm thinking about.
So on this one, I mean, that PE ratio of 19 is probably quite a bit lower than its peers, right? Than the other technology sectors out there. So you would consider that a cheap stock, right?
Yes.
And what you have to consider when you're making kind of these decisions is it cheap for a reason? Is there a reason why it's not liked? I mean, again, you're making the decision along with millions of other people, right? When you buy, somebody else is selling, okay, and vice versa. And so there's somebody that has the opposite view of you. Is it cheap for a reason? It deserves to be cheap because all these anticipated changes that you just laid out are not going to be enough to compete with somebody else, right? And so just because something is cheap doesn't mean it's a good buy. Yes, it's better. I think you have a better opportunity to make more money if you buy something cheaper, but it doesn't mean that you are going to make good money. It can be cheap for a reason. And so I'll leave it at that.
So we're at the end of our half hour. It is lunch. We got to go back to work, Frank. No more sitting around doing nothing stuff. But did you have any last words, sir, before we head out? Anything you want to
No,
give? Any feedback?
I actually I enjoyed today's meeting because, you know, again, we want to go away from the speculation. If you're going to speculate, go ahead, knock yourself out. But if you want to do a little bit of more investing, look at some things, right? And we talked about some things that we can look at. We talked about PE, we talked about dividend yields, we talked about how to compare these things, right? PEs across time, PEs across peers. But that's just one of the ways. I mean, that's a simple way. There's a lot of more fundamental analysis that you can do, but at least we're getting into kind of a more substantive reason for why you would want to, you know, own these stocks in the long run.
So if you want to go ahead and drop us some comments or discussion items, we'll be taking that. We do look at your comments and we do give feedback the next week. So if you want to go and drop those, again, if you like what you're seeing, give us some hearts. And I appreciate you, sir. Thanks for joining again. Yes. We'll be back next Friday for the lunch hour. Give it about a half-hour show. So check back with us next week.
Any questions? Please drop off some questions and we'll answer them on the next show.
Absolutely. Thanks, guys. You guys have a good rest of the remaining week.